Welcome to this session on commodity derivatives and risk management. Today's objective is to discuss more on how mark-to-market margin is calculated, what are commodity spreads and what are commodity options. But before I go to the calculation of mark-to-market margin, I would like to just rephrase what is the what we discussed in last couple of sessions in terms of different margins. So futures contract requires initial margin to be paid. So this is our, we calculate this, or exchanges use value at risk method to calculate the initial margin, and this margin is given by both long and short futures holder. Now this is the, exchanges also ask for sometimes excess loss margin. Exchanges also ask for additional margin. Exchanges also sometimes levy special margin. Special margin, this excess margin is asked to both parties. Additional margin is also asked to be both parties, but special margin is asked either to long or short futures position holders. Suppose on 2nd May, let us say on 2nd May 2016, futures price for, let us say, cotton maturity for, let us say, October 2016, closed at rupees 10,000 a bale. Now on 3rd May 2016, if the same futures price, that is the cotton contract maturing on October 2016, goes to a price level of plus minus 4%, suppose this is 4% and minus 4%, that is 10,400 and 9,600. Suppose futures price touches this label, then long futures position holder futures are asked to deposit special margin. If futures price touches this label, that is 9,600 label, then short futures holders are asked to pay margin. Now let us go to our today's objective of understanding more on mark-to-market margin. So what is exactly a mark-to-market margin? So all open position are mark to market. So let's go back to our example on a cotton producer. What is the fear of the cotton producer? Cotton producer fears price will go down in future. How he will be mitigating this risk? By taking short futures contract. Let's say on 2nd May 2016, cotton producer, let me make him as CP, cotton producer took short futures for 12 contracts for October 2016 delivery at a price of rupees 770 per bill. So this is transaction was undertaken at the commodity exchange on 2nd May 2016. Now let's when the exchange closed on 2nd May 2016, the October 2016 contract closed at, let us say, rupees 17,790. So cotton producer took short futures at a price of 770 on 2nd May. Now he agreed to sell when it is short, he sold the futures contract at 770. Now what option he has in available to him? If he would like to square up this contract on by end of the day, that is 2nd May 2016, that means he can do so at a price of 17,790. So he sold something at 17,770, he can buy the same thing only at 17,790. So what is the gain or loss? Gain from this is he will be receiving, by selling the futures, he will be receiving 770, and if he squares up his position, he will be paying. So this means he has a gain of minus 20, or he will incur loss of 20 rupees per bill, and total loss will be 20 into 25 bales per contract and 12 contracts. So this is going to be the total loss for the cotton producer, and because this is the, even if it is a notional loss, he is going to pay this amount of money to the to the counterparty, the cotton producer who has taken a short futures. Somebody else must have taken a long futures position. So cotton producer will pay this loss to the counterparty. As we all know that derivatives are zero sum game. So the loss of the cotton producer is going to be the gain of the counterparty. So by next day, the cotton producer will be, that is by next 3rd May 2016, the cotton producer should be paying this amount of money to the counterparty. Now let us go to the next day. So similarly, on 3rd May 2016, the same October 2016 contract, futures contract, closed at, let us say, closed price or closing price is, let us say, 1707.50. Now, the mark to market margin will also be calculated on 3rd May. However, this initial price has no more relevant for the mark to market margin calculation for the 3rd May. So, this is no more relevant. What is relevant is this price, the price prevailing at the end of the day closing price on 2nd May, that is 70,790. So, same the cotton producer had as if, so let us go to our next page. So, cotton producer had short futures at 17,790 and 3rd May 2016 October 2016 contract closed at 17,750. So, exactly the same logic will be applied. He has agreed to sell something at 790 and he can buy the same thing at 17,750. So, what will be his gain or loss? Gain will be he sold something at 17,790 and he can buy. So, that means he has a 40 rupees gain per bale per bale. So, total gain will be 40 into 25 into 12. So, the same process will go on till this cotton producer squares up his position. If it does not square up position till the this October 2016 contract comes to an end, then it will lead to a delivery. This party will deliver the underlying, and whoever is the counterparty will take delivery of the underlying, that is a cotton contract. Now, let us go back to a Excel calculation which I have done. Let us, as I mentioned, mark to market margin, all open positions are marked to market on daily basis till a party squares up its position. So, let us go to this Excel file. Exactly same thing I have mentioned here. Here May 1, 2016, a trader took short futures position on 12 contract for October 2016 delivery. Contract underlying is 25 bales, number of contracts is 12, price per bale at which the party took short futures position, that is 17,770. Initial margin and extreme loss margin is 5%. So, total value of the short position is 5,53,31,000. And how much margin to be deposited? Margin to be deposited is 5% of this value is going to be the total margin deposit. Now, let us go to, so by end of the May 1st, the cotton contract for October delivery closed at 17,840. So, that leads to a mark to market gain of minus 70, means mark to market loss of 70 rupees. So, total mark to market margin gain is minus 21,000. So, that means this cotton producer is going to give 21,000 to the counterparty. Similarly, let us say on May 2nd, this contract closed at 17,810. So when we are comparing this price, because 17,770 will no more be relevant. So when we are comparing this price 17,810 with 17,840, this cotton producer has now 30 rupees gain. So he will be getting 9,000 from the counterparty. So this process goes on till this cotton producer squares up the position. Suppose on May 16, 2016, the cotton producer squared up its position. So if we sum all this total mark to market gain or loss, so he has gained 15,000 rupees on all these 12 contracts, and the day he squares up his position, he gets back, this cotton producer gets back this initial margin of 2,66,550 rupees what he had deposited. So this is an example of how mark to market margin is calculated. And one thing I would like to say here is that the cotton producer has this is a mark to market margin calculation for only one contract. Let's say the cotton producer has taken a short futures contract in October 2016 contract as well as a short futures contract in November 2016 contract. So the mark to market margin calculation will be done separately for both of these contracts, as if whatever the prevailing closing price for October 2016 contract will be used to calculate the mark to market price for October contract. Similarly, on 1st May, 2nd May, 3rd May, the closing price of November 2016 futures contract will be used to calculate the mark to market margin for the same cotton producer, and the exchange will ask the cotton producer to deposit the mark to market margin for both contracts if the trader has open position for both contracts. This brings an end to our discussion on mark to market margin. And here I would like to discuss little more on how the closing price or settlement price is calculated by the exchanges. So this is very, very important because the daily settlement and closing price is the price based on which the mark to market margin is calculated. So daily settlement price is not the last trading price. Daily settlement price is the weighted average price of futures contract traded during a specific time period during the close of the trading for a given day. So it's not the one price only, it is a weighted average price of some half an hour trades. So whatever futures contract traded during the last half an hour of the trading period, that is the weighted average of that is taken as the daily closing price or settlement price. Now let's go back to what happens when the contract comes to an end. Let's say October, same cotton contract, October 2016 contract has the maturity on 29th October 2016. Let's say on end of this date, by end of 29th October 2016, some 400 contracts are open. So that means 400 long position, 400 long futures as well as 400 short futures are there. If you recall, I had when I was discussing the contract specification part, we discussed about the delivery logic. For a cotton contract, the delivery logic was compulsory delivery. So, let us first spend some time on understanding what are the different types of delivery logic can happen. So, you have a delivery logic, you can have compulsory delivery, you have buyers or sellers or both choice. Let us understand, if 400 contracts are open on the last day, contract expiry date, what will happen in the compulsory delivery. So, in the compulsory delivery means the buyers have to take delivery and sellers have to deliver the underlying. Underlying means sellers have to deliver the warehouse receipt. Now, so in this case, so on expiry plus expiry date, the buyers have to pay money, and buyers means long futures position holders, and sellers means short future sellers short futures position to pay warehouse receipts. So, because it is compulsory delivery, for compulsory delivery, warehouse receipts are for 400 contracts will be given by the sellers. Now, what is the amount of money will be paid by the buyers? The buyers will be paying the price calculated by the exchange on the last day of the contract maturity, that is the price prevailing on the 29th October. So, which price they will take? If you recall, we had discussed something called a due date rate, DDR, due date rate or final settlement price, because on 29th October 2016 we will not have any futures contract. So, what we will have is the only spot price, but which spot price to be considered? So, exchanges normally identify or they take a poll, and from different market players they collect spot prices, and based on some averaging they find out what is the due date rate or final settlement price. So, that final settlement price is paid by the buyers, and anyway sellers deliver the warehouse receipts or for 400 contracts. Now, let us go to understand little bit on what will happen if the delivery logic is not compulsory delivery. It could be buyer's choice or seller choice or both choice. Let us go to what will happen if the delivery logic is buyer's choice. So, we have open position for open position for 400 contracts. Let us say delivery logic, I am using the word DL, delivery logic is buyer's choice. If buyer's choice is there and buyers give a indication to the exchange that they would like to take delivery of cotton for worth of 300 contracts. The sellers have no choice in this case. The sellers have to provide warehouse receipts for 300 contracts, and remaining 100 contracts worth of cotton will be settled through cash. So, that will be the payment will be made based on the final settlement price. If delivery logic is seller's choice, suppose sellers give an indication that they would like to only deliver 75 contracts, underlying for 75 contracts. So, the sellers will be now, sellers will be delivering now warehouse receipt for 75 contracts, and rest 325 contracts will be settled through cash. And if it is both choice, buyers as well as sellers, so the lowest of both buyers and sellers will be giving their choice to the exchange, and depending upon whichever is the lowest, then that amount of warehouse receipt will be given to the exchange, and remaining will be settled through the cash. So, in this case, if buyers give 300 contract and sellers give 300 contract, so both choice will lead to 700 contracts to be delivered and rest 425 to be settled through the cash. Now, let us go to this particular slide. This particular slide shows how order matching will happen if depending upon the delivery logic. So, this particular slide is self-explanatory. I am not going into much detail. You can spend some time understanding this details which is mentioned here. I have also mentioned how the due date rate is calculated. Due date rate calculation or final settlement price, DDR or FSP, is the price at which traders with open position settle the trades after the expiry. It is normally the average spot price of the underlying asset at some major spot markets over some days, and each exchange very categorically mentions how they will calculate the due date rate or final settlement price. If you recollect the contract specification document which I had shown it to you all, the 8-page PDF document from multi-commodity exchange very categorically explains how DDR will be calculated for the cotton, from which market they will collect, what mechanism will be used. Now, let us say, do really traders use the exchange platform for taking delivery or giving delivery? This particular link So, this particular link, if you can see, this one I have downloaded from NCDEX website. This shows for the month of May 2016 the amount of quantity delivered through the exchange clearing process. So, you have different commodities and the total amount of different commodities which have been delivered by buyers and sellers through the exchange platform. So, this is something interesting I thought of sharing. So, you have a sugar, medium sugar of whatever has been the total amount of delivery has been 10,790 metric ton. So, different commodities have different commodities amounts are given. So, this indicates the amount of delivery which buyers and sellers have done in the exchange platform. Now, I have also in the previous previous sessions, I have explained what is a delivery pay in out, delivery pay in date, pay in date for funds, delivery payout date, payout that will be payout date for funds. So, this is now just as a snapshot, I would like to show you something. This is again I have downloaded from the NCDEX website. Which date? Trade date is 25th May 2016. What are the commodities? This is the barley, 2 commodities for barley, 4 commodities for chana, and 3 commodities for coriander. It has nothing to, I mean, there are many more commodities available. I have just taken a snapshot. So, you have a, let us say go back to chana contract. trade date is 25th May, but the contract matures on 20th of June. This contract matures on 20th of July. This contract matures on 19th of August. This is 20th of September. So the when exchange opened, the futures contract, the first contract to be executed, first buy and sell order to match is at 6,083 rupees. Day high, day low, day close, and day. This is LTP. This is what I would like to each of you to focus. That is your even if the close price is 6,083, but the LTP is a if the last traded price is 6,043, but the close price has been calculated as 6,083. So this is the price for this price will be, close price will be used to calculate daily mark to market margin, not the last traded price. Last traded price is the last one trade which has been executed at the exchange platform, but the close price is the average price of average trades happening within half an hour of closing. Similarly, you have LTP of 6130 for Chana, that is July contract, but close is 6160. Similarly, if you can see that the LTP is different than the close price, and this close price is used to calculate the mark to market margin on daily basis. So this brings an end to our discussion for this session. So we'll continue with the remaining part of futures discussion in the next session. Thank you, all of you.